Build your dreams, live rich, and leave rich.
Hello and welcome. My whole philosophy is that to live rich isn't about living lavishly, it's about living peacefully. And trust me, nothing shatters your peace of mind faster than walking onto a battlefield without a plan. The stock market? It's that battlefield. So before you even think about putting a single rupee at risk, you absolutely need a strategy, a clear plan of attack that is built for you. Today, we're going to map out the entire territory. Okay, first things first, and I need you to really hear me on this. Everything we're talking about today is for your education only. Active trading is incredibly risky. And look, the data from SEBI is, well, it's pretty sobering. 9 out of 10 individual traders in the futures and options segment end up losing money. This is not a game. So please, before you make any decisions with your hard-earned money, talk to a SEBI-registered financial advisor. Seriously. All right, here's our game plan for this explainer. We're going to kick things off by busting a huge myth about what trading even is. Then I'm going to give you a really simple analogy, the ocean, that'll make all of this click. From there, we'll take a deep dive into the 4 main strategies, spell out the key differences, and then, and this is the most important part, we'll finish up by helping you figure out which strategy, if any, is the right one for you. Okay, let's jump right in. When I say the word trading, what's the first image that pops into your head? Come on, be honest. It's probably some guy surrounded by like 20 flashing screens, frantically clicking away, sweating, maybe yelling into a phone, right? Well, that image is the biggest myth in finance. The truth is, trading isn't just one thing. It's a catch-all term for at least 4 completely different sports, played on 4 totally different fields with 4 unique sets of rules. Just look at this, Trader A and Trader B. Is there any way you can say they're playing the same game? No way. Trader A is in an all-out sprint, making split-second decisions under massive stress. Trader B is running a marathon, totally calm, looking at a timeline of months, maybe even years. Calling both of them traders is like saying a Formula One driver and a long-haul truck driver are both just drivers. I mean, yeah, it's technically true, but it misses the entire point of what they're actually doing. So to really get a handle on these differences, I want you to picture something with me. Imagine the stock market is a huge, unpredictable ocean. One minute, it's perfectly calm. The next, there's a raging storm. Your success, and more importantly, your survival, comes down to one thing, the kind of boat you choose to sail in. Your boat is your strategy. And here they are, the 4 main vessels. You've got the scalper on a jet ski, just zipping in and out, catching the tiniest little ripples. Then there's the day trader in a speedboat. They're fast, they're agile, but they always come back to the safety of the harbor before dark. Then you've got the patient surfer, the swing trader, who waits for that one perfect massive wave and rides it for days. And finally, the position trader, the captain of a gigantic cargo ship, who sets a course for a faraway port and just sails, completely ignoring the little choppy waves of the day. 4 vessels, 4 totally different ways to handle the very same ocean. So now let's get into the real meat of it. We're going to go down into the engine room of each one of these vessels. We'll look at the mechanics, the mindset you need, and the kind of lifestyle that goes with each of these 4 strategies. You're going to want to pay close attention here because one of these might sound like it was made for you, while another might just sound like your absolute worst nightmare. First up, the adrenaline junkie on the jet ski, the scalper. This is without a doubt the most intense, high-speed version of trading that exists. Scalpers are not looking to catch a wave. They're trying to profit from the tiny, almost invisible ripples on the surface of the water. They operate on charts that measure time in 1-minute chunks, or sometimes even second by second. The entire goal is to get in and get out, sometimes within seconds, just to grab a minuscule change in price. So you're probably thinking, how on earth is making 50 paisa on a trade even worth the effort? Well, the secret sauce here is 2 things, massive volume and something called leverage. Take a look at this chart. A normal investor might buy 10 shares and wait for months to make 100 rupees profit on each one. A scalper flips that model on its head. They'll use a ton of capital, often borrowed capital through leverage to make their position bigger, to buy something like 2,000 shares. And their only goal is to make that tiny 50 paisa profit on each share and get out in under 60 seconds. The total profit looks the same, sure, but the risk, the speed, and the capital involved are from another planet. Now let me be absolutely 100% clear, this is not a game for beginners. This is for professionals, people with crazy expensive setups and the discipline of a monk. You need a heart of stone to be a scalper. You cannot have emotions. 0. Your decision-making has to be faster than a blink. If you hesitate for even 1 second, a tiny profit can instantly turn into a huge loss. For anyone new to the market, trying to scalp is like taking that jet ski straight into a cyclone. It is the fastest way to drown, period.
All right, let's move on to our speedboat captain, the day trader. The single most important rule of day trading, also called intraday trading, is simple, but it is absolute. You must close out every single position you have before the market shuts down at 3:30 p.m. You start your day with cash, you end your day with cash. There are no exceptions to this rule, ever.
Okay, so why would anyone tie themselves to such a strict rule? Because in return, they get a superpower. I call it overnight peace. Just think about it for a second. Let's say some crazy news breaks in the US markets overnight, or a company you were watching releases terrible earnings before the bell rings. Or what if global markets just crash while you're sleeping? For the day trader, none of that matters, not one bit. Because they own zero stocks overnight, they have zero overnight risk. They get to sleep like a baby and start completely fresh the next morning. But that peace of mind comes with a pretty steep price tag. And the price is your entire workday. From 9:15 in the morning to 3:30 in the afternoon, you are basically handcuffed to your trading screen. It is a 6-hour marathon of nonstop, intense focus. Let's be real, you can't just do this on your lunch break from your regular 9 to 5 job. For anyone who's successful at it, day trading is the full-time job. And now, let's meet the surfer, our swing trader. This is a whole different vibe. Unlike the crazy frantic energy of the jet ski and the speedboat, the surfer is all about patience. They completely ignore all the chaotic, choppy waves close to the shore. Instead, they paddle out into the calm and they wait. They wait for that one big, powerful, perfectly formed wave to start building. They catch that single swing in price, ride it for a few days or maybe a few weeks, and then they hop off before it crashes. This slide right here really shows you the massive difference in lifestyle. A day trader is glued to a 5-minute chart trying to scalp a 1 or 2% move. The swing trader, they might check the market once a day, maybe in the evening. They're looking at daily charts, and they're aiming to capture a much bigger move, like 10 or 15% over a couple of weeks. This is exactly why swing trading is so popular with people who have full-time careers. It's a game of patience and planning, not a game of reflexes. So how do they actually spot one of these waves? Well, they mostly use something called technical analysis. They're basically looking for clues that a stock has strong momentum. Is it starting to make a clear trend upwards? Has it just broken out of a range where it was stuck for a while? They use tools like trend lines and moving averages to get confirmation that a stock is picking up speed. Their whole job is to identify that momentum, hop on for the ride, and then get off when it looks like the wave is running out of energy. And that brings us to our final vessel, the majestic cargo ship, the position trader. This strategy is really the bridge that connects the world of active trading with long-term investing. A position trader couldn't care less about the daily waves or even the weekly swings. They've plotted a course to a destination that's months or sometimes even years down the line. Their decisions are driven entirely by the big picture. Their method is usually what's called a top-down approach, based on fundamentals. They start with the big questions. What's going on in the global economy? Based on that, what industries in our own country look like they're about to take off? For example, maybe the government announces a huge new policy to support electric vehicles. A position trader would analyze that entire sector, find what they believe is the strongest company within it, and then invest with the plan to hold on for the entire multi-year megatrend. The mindset here is a complete 180 from where we started. They are not trying to time the market. Their entire philosophy is built on time in the market. They know for a fact that there will be storms, there will be market corrections, there will be scary downturns. But the captain of a cargo ship doesn't panic and abandon ship just because the weather gets bad. They have deep conviction in their long-term research and they ride out the storm, believing that over their long journey, the good times will more than make up for the bad. Whew! Okay, we have covered a ton of ground. So let's take a breath and put everything side by side. I want to give you a super simple, no jargon summary so you can really lock in these different ideas. Think of this as your quick reference guide to the 4 battlefields we've talked about. This table just lays it all out perfectly. As you go down the list, from scalping to position trading, just look at how the time frame explodes, from just a few seconds to many years. The type of analysis you do completely changes, from pure chart reading or technicals to deep business analysis or fundamentals. And maybe most importantly for your own life, look at the screen time required. It goes from all day, every day, down to something pretty minimal. It's like 4 different universes, all hiding under that one simple word, trading. And that brings us to the most important question of the day. Now that you understand the different boats you can take, it's time to look in the mirror. Which one of these actually fits your life, your day job, your personality, and honestly, your ability to handle stress? This is the question you have to ask yourself. The single biggest mistake I see people make is a mismatch between their personality and their strategy. They have the calm, patient mindset of a cargo ship captain, but they're trying to ride a jet ski, panicking over every tiny little dip in the market. Or they're an adrenaline junkie at heart, but they're stuck on a slow-moving cargo ship, getting bored and making terrible, impulsive decisions. You have to know your vessel, and you have to know yourself. And that right there is the bottom line. The goal is not to find the most profitable strategy on paper. The goal is to find the strategy that is sustainable for you, the one that actually fits your schedule, your bank account, and most importantly, your peace of mind. The best strategy is and will always be the one that lets you sleep peacefully at night. Choose your vessel wisely. Thanks for joining me.